Good evening, investors. Welcome back with me, Dini, on KleverStock, serving you the latest updates for the closing bell this evening. Kicking it off with the evening updates from our local bourse, Bursa Malaysia wrapped up the trading week on a highly bullish note this Friday afternoon, with the benchmark index staging a powerful rally as institutional investors aggressively pushed capital back into large cap equities following Bank Negara Malaysia's reassuring assessment of the local economy. At the 4 p.m. closing bell, the benchmark FBM KLCI surged an impressive 14.68 points, closing out the week at 1,692.32. The buying momentum was felt widely across the main market, sparking a broad-based lift for the country's top industrial, financial, and consumer blue chips. The broader base FVM Emas Index beautifully captured this upward swing, jumping a massive 91 points to wrap up Friday's session at 12,531.48. In contrast to the large cap party, small cap and speculative retail equities took a minor breather, causing the FVM ACE Index to buck the wider trend, slipping 11.68 points to settle at 4,879.41. Overall market breadth finished firmly in positive territory, with 600 gaining counters easily outpacing 449 losers, while a substantial 557 equities remain locked completely unchanged. Trading participation expanded healthily to close out the week. Total market turnover crossed 2.296 billion shares traded, generating an aggregate transactional value of 1.67 billion ringgit. Market strategists noted that yesterday's central bank decision to maintain the OPR at 2.75%, coupled with strong assurance that our domestic fundamentals remain fully insulated from West Asian geopolitical external shocks, provided a massive confidence shot for equity traders, sending local benchmarks to a strong weekly finish. Now for some local news developments. The region's manufacturing sector is undergoing a major technological shift. As industrial operators actively contend with rising production costs, supply chain volatility, structural labor shortage, and changing customer expectations, many are officially shifting to intelligent AI-powered systems to defend their long-term profit margins. Responding to this surge in operational demand, prominent enterprise software provider Micro announced on Thursday the expansion of its manufacturing software platform through the launch of Micro X. The upgraded solution is specifically engineered to inject AI-native capabilities directly into factory floor environments, allowing businesses to completely automate complex processes, optimize resource allocation, and accelerate data-driven decision-making in a volatile macroeconomic climate. Company executives note that the rollout comes at a time when industrial companies are forced to look beyond conventional digitalization. While traditional enterprise resource planning systems successfully centralize data and standardize paperwork, those systems still heavily rely on human operators to manually interpret screens, spot processing bottlenecks, and execute corrective actions. Micro X aims to bridge this operational gap by utilizing artificial intelligence throughout the entire manufacturing process, examining incoming transaction data in real time to actively recommend corporate steps and execute routine tasks autonomously. Nur Fadia Shifa, Micro's Vice President of Strategic Communications, emphasized that while modern factories generate massive amounts of daily operational metrics, data alone cannot improve physical productivity. She stated that modern enterprises require AI systems that understand the specific context behind every custom order, individual machine capability, and active assembly line, then automatically suggest or deploy the next best corrective action. According to the company, this deep structural intelligence will allow manufacturers to identify operational anomalies much earlier, seamlessly automate complex workflows across inventory, procurement, and quality control lines, and also dramatically reduce resource wastage when external supply chain disruptions occur. Continuing with some economic news. Malaysian consumers continued their spending momentum through the month of May, though at a noticeably more moderate pace compared to the explosive growth seen earlier in this year. Fresh data released by the Department of Statistics Malaysia, or DOSM, reveals that total wholesale and retail trade for May accumulated a massive 171.3 billion ringgit. While this represents an impressive 11% expansion compared to the same month last year, it marks a distinct deceleration from a staggering 15.3% year-on-year surge logged back in April. Looking under the hood of the distributive trade metrics, wholesale operations serve as the primary growth engine, recording total sales of 80.8 billion ringgit, a sharp 18.4% annual jump. This massive wholesale surge was heavily driven by elevated market prices for commercial petrol, diesel, lubricants, and liquefied petroleum gas, directly tracking the recent volatility across global crude benchmarks. Additionally, wholesalers book firm performance across essential goods, including food, beverages, agricultural, raw materials, and household assets like pharmaceuticals and jewelry. Meanwhile, pure retail trade expanded by a steady 7.2% to touch 71.9 billion ringgit. Cash registers across supermarkets and department stores stayed busy, buoyed heavily by a dense holiday calendar that packed Labor Day, Wesak Day, and the school holidays into a single month. This festive clustering generated robust consumer demand for fresh produce, dairy products, and medical goods. Furthermore, digital commerce maintained excellent resilience, with the online retail sales index accelerating by 8.6% in May, outpacing the 7.1% growth recorded in the preceding month. In stark contrast to the broader retail wins, the automotive market experienced a sudden bump in the road. The motor vehicles subsector skidded by 2.3% year-on-year, dropping to 18.6 billion ringgit in May, dragged down directly by lower showroom vehicle deliveries. When adjusting for volume rather than pure ringgit value, overall wholesale and retail trade volume grew by 3.1% annually, though it notched a minor 1.3% contraction on a month-on-month basis. Economists note that while the consumer appetite remains undeniably intact, the slight volume dip suggests that families are starting to spend a bit more selective as global cost pressures subtly pass through to the domestic shelf. Moving on to the corporate front. Lianson Fleet Group Berhad has announced a massive expansion of its dry bulk shipping footprint. In a regulatory filing with Bursa Malaysia, the group revealed that its wholly owned subsidiary, Lianson Fleet Pte Ltd, has signed two separate memoranda of agreement to acquire two high-capacity Ultramax class bulk carriers, the MV Tian Mu Shan and the MV Yandang Shan. The dual vessel acquisition is being executed for a total cash consideration of $52.32 million, which converts to approximately 213.2 million ringgit. Management highlighted that the asset purchase aligns directly with its overarching corporate strategy to aggressively enlarge its marine transport division, focusing specifically on long-term charter asset classes. Lianson Fleet Managing Director Lim Chern Wui stated that expanding the bulk carrier fleet allows the group to actively participate in global dry bulk shipping markets, which are driven by entirely different demand cycles compared to their core upstream offshore business lines. He noted that the move strategically positions the group with a stronger foundation of recurring income, greater earnings resilience, and enhanced participation across regional and international maritime value chains. The incoming Ultramax vessels boast a massive deadweight tonnage of 63,437 and 63,301 tons, respectively, making them significantly larger than the group's existing bulk carrier fleet of Supramaxes. Delivery of the MV Tianmu Shan is scheduled to take place between June 11 and August 11, 2026, while the MV Yandang Shan is expected to be handed over between September 10 and October 10, 2026, with both transactions targeted for full completion by October 2026. Once these two vessels are fully integrated alongside a previously announced Supramax bulk carrier arriving this August, Lionsden Fleet's total asset matrix will officially expand to 41 vessels. The updated fleet architecture will comprise 17 barges, 17 tugboats, and 7 dedicated bulk carriers, firmly reinforcing the group's market position as Malaysia's absolute largest dry bulk maritime asset player. Rounding off today's closing bell with oil and gas update. Integrated Facilities Management provider GFM Services Berhad has secured a major financial windfall for its expanding energy division. The group announced that its indirect subsidiary HIMS Integrated Services STNBHD has officially received 2 substantial release orders totaling 148.2 million ringgit to execute critical plant turnaround work packages at the Pengerang Integrated Complex or PIC located in Johor. The multi-million ringgit release orders were issued by Pengerang Petrochemical Company STNBHD and Pengerang Refining Company STNBHD. The work packages are formally carved out under the group's existing integrated turnaround main mechanical and maintenance mechanical static contract, frequently referred to in the market as the TA4MS framework. This deployment carries immense operational significance as it marks the first major comprehensive turnaround maintenance cycle at the PIC since the massive integrated downstream refining complex originally commenced commercial operations back in 2019. Management revealed that the secured work scopes are highly complex and will require an intensive volume of technical man-hours to safely execute. Financially, the revenue generated from these works is modeled to contribute highly positively toward the group's earnings metrics for the financial year ending December 31, 2027. GFM Group Managing Director Ruslan Nordin noted that this upcoming Pengerang turnaround is on track to be among the absolute largest industrial maintenance events ever executed in Malaysia. He stated that the project presents a premier large-scale opportunity for GFM's energy division to prove its technical capacity to mobilize massive labor teams and manage complex mechanical scopes within a highly regulated downstream environment. He added that through deliberate strategic acquisitions, GFM has successfully evolved from a traditional pure-play facilities management firm into a multi-pronged technical services group and expects to progressively secure additional maintenance work scopes as the localized Pengerang turnaround activities advance further. That's a wrap for Closing Bell updates with me, Dini. Thank you, investors. We shall catch up in the next session. Goodbye.